Welcome to the next section for us, Chapter 7, the Board of Directors, Committees and Remuneration. An important chapter for us, and indeed quite a long one as well. Given this is a leader or leadership exam, this area is very important to us, and certainly some aspects of this particular mind map I would highlight as being certainly within my sort of top 10 or top 12 topics. More of that as we move through the mind map. So let's take a look at the first area in this chapter 7. What we'll see is there's reference here to the board in a broad sense. Now, what do we mean by the board, and indeed, what are the functions of the board? Well, in terms of the requirement for leadership, let's break down this idea of leadership. Now, really what we're saying here is that for a company to be successful, the board needs to be effective and entrepreneurial. More of those areas later. In essence, the role is to promote the long-term sustainable success of the company. Now, let's stop there for a moment. So we're talking about a group of individuals, that if they want to be effective and indeed entrepreneurial, they have to ensure the long-term sustainable success of the business. What does that mean? Well, really, when we think about the core of any for-profit business, generally speaking, it's about shareholder wealth maximization, and note, in the long term. So it's about a return to shareholders on the back of stewardship of their assets in the form of a dividend, and also capital growth in the shares. So that's value for shareholders. Now, note that leadership also means contributing to the wider society. So it seems to me when we think about the board and the leadership of the board, really it's twofold. We need to have people, individuals, directors, both executive directors and indeed NEDs, with skills, the skills to be effective, some semblance of experience and expertise in the business or entrepreneurial sense, and a recognition that they focus on long-term sustainable success with a balance between the value for shareholders and indeed wider society. So let's look next at the role of directors. Now, note this is twofold. So on the one hand, we have executive, and on the other hand, we have non-executive. Let's be 100% clear on exactly what we mean by that. So in the first instance, executive directors are employees, senior employees no less, and they will be leading various business functions. What do we mean by that? Well, marketing, sales, finance, production, IT. And they are tasked, obviously, with guarding shareholders' interest, as we mentioned above. What does that mean? Well, it means the stewardship role. They're in control of assets effectively owned by another. This is back to the area of agency. The idea that we have the agents managing and running and providing a stewardship role over assets for the principals, i.e. the shareholders. But remember, we're always referring back to other shareholders. It's not just one-sided, or at least it shouldn't be. And it certainly shouldn't be the idea that executive directors work in their own interests. Now, on the other side of the fence, non-executive directors. Now note, they are not employees. Bear with me one second. Sorry, just go back a little bit. They are not employees, and indeed they're not involved in the day-to-day running or management of the business. What they're there for is some form of sort of balancing influence. In other words, an influence that really we take from, let's say, the shareholders in terms of their needs, wealth maximization, etc., and indeed other stakeholders as well, and also, of course, the interests of the executive directors. We need good people. They need to be paid properly. They need to be incentivized, motivated, etc. Next area for us is really sort of the idea of how a board sort of operates, and indeed composition. I've just cut and pasted this from the study hub. Let's look at the key areas. Now, the first one is the area of guiding corporate strategies, or indeed plans, and indeed over and above that, the risk side, the financial side, budgets, etc. Okay. Outside of that, certainly objectives, corporate objectives will be important, and that will cascade down from the top. We're talking long-term, medium-term, etc. Outside of that, the performance of the business. We need objectives, yes, but we need to know how we are performing against those objectives. Next key point is expenditure. Capital expenditure will probably be the most significant. For example, acquisitions of other businesses, or perhaps exiting or divesting. Next area is governance procedures. In other words, the idea that this monitoring role, for example, that NEDs have, and this area of governance, i.e. the smooth or correct direction and management of businesses, that's key too. And then the next area is really personnel. The idea of finding, selecting, compensating, motivating, etc. Key objectives, and indeed, planning for the future, i.e. succession planning. So a very, very comprehensive set of requirements for sure. Next area for us is, responsibility for corporate leadership. And what we mean by that is, how do we put what we've said up top into play? What is it for an executive board, and indeed NEDs, what is it for them to be sort of responsible in the broad sense of the word? Well, several factors to consider. A responsible board is going to set the correct tone at the top. Now, this is a good little phrase, nice little area to slot into an answer. I'm sure that you understand what I mean by that. I mean that really everything stems from above. The vibe, the culture, the attitude comes from the top. It comes from the board. So the board are responsible for really setting out how the company works, the vision, and really how people operate. Outside of that, of course, the area of mission, i.e. the company's purpose, and indeed vision, the preferred future, and broadly speaking, objectives and values. They have a responsibility for setting these and also communicating them, making them clear to lower levels, a la tone at the top. Indeed, over and above that, clearly board members need to not only talk the talk, but also walk the walk. So they need to act in line with, for example, the values, the mission, the vision, etc. Finally, risk-aware culture. Clearly, most businesses, just about every business, faces risks in some way, shape, or form. There need to be firm, stringent, and comprehensive procedures for embedding this idea of a culture. What do we mean by that? Well, we mean broadly an understanding of how important risks are, particularly downside risks, and also systems in play to identify these risks, to sort of evaluate them, prioritize them, likelihood and impact, for example, and then to manage them forward and to monitor them. Next area for us is the area of composition and indeed effectiveness. Now, we've said up top that an effective board needs to have expertise, skills, etc. Now, in terms of other key points outside of that, first things first, there needs to be enough directors, but not too many. Second point, skills. I mean, effective directors and effective board, they require a breadth of skills in many, many different areas. I'm not just talking about technical expertise, finance, accounting, etc. A good set of directors have a multitude of other skills. For example, interpersonal skills, motivational skills, etc. In terms of diversity, this is a word that we'll see many, many times throughout this mind map. I mean, on a basic level, because there are several levels to this, we're talking about, a varied group, in terms of gender, in terms of background, in terms of race, etc. But there's more to it than just that. We need, on this effective board, as it were, we need to have a wide degree of diversity. And in terms of NEDs, certainly in the UK, there would be a requirement for the board to have a minimum of 50% of NEDs. And when we think about NEDs, the big word with NEDs is independence, but there are other areas. What are NEDs supposed to do apart from to bring independence to the business? Well, certainly, to ensure the integrity, the honesty of reporting, where the company reports in whatever way it does, let's say financial statements or an integrated report. Those reports need to be honest because people are going to rely on those reports. Related party transactions, in other words, so transactions involving companies, individuals, or other groups that could be seen to be connected with the business. We need to be careful about that because there is the possibility for some sort of bias, perhaps, if there is some sort of relationship. Outside of that, as we said up top, nominations and indeed, selecting board members, focusing on the future, i.e. succession, that's key as well. And then the next point is remuneration. Remuneration is two-sided, really, isn't it? We have to have remuneration levels within a business that attract the right sort of people. Good quality, high-end directors are expensive. You need to have the right package. Outside of that, we need to balance. What we can't have, for example, is executive directors having too much influence on their pay, on the elements included within their financial packages. Next area for us is, just going back a bit, this is something that really is linked with the origins of corporate governance, certainly in the UK. It's this whole area of the role, or the split of the role, between the chief executive officer and the chairman. If we go back to the early 1990s in the UK, really the origins of corporate governance were such that the Mirror Group scandal, this is something that you can look up, really kicked off in 1991, really the beginnings of corporate governance. The first set of reports really began in 1992 with the Cadbury report in the UK. And really what we're saying here is that prior to that point, the corporate governance regime really didn't exist. There were regulations, Companies Act, stock exchange regs, etc. But there was no fixed corporate governance regime. And the Mirror Group scandal in the UK really kicked it off. And that scandal involved it involved a very dominant CEO and chairman. This particular person, Robert Maxwell, held both roles within the Mirror Group and ended up embezzling, I think, to the tune of £900 million from the business because he had too much power. So this area is, you'll see it referenced in many corporate governance regimes and indeed in much discussion, the need for the separation of those two roles. What are the roles? Well, we know that the chair or the chairman really heads the board of directors, and indeed we know that the CEO, given the word executive, leads the management team. So really there's two sides, or there should be two separate sides to this. On the one hand, we have an individual who is overseeing and indeed leading the board, leading meetings, organizing, etc., etc. And on the other hand, we have the executive side. The CEO is responsible for the business itself, day-to-day management and running, etc. Next area for us is the separation of the roles. Well, what are the key reasons? I mean, why not simply have the same CEO and chairman, notwithstanding the example that I gave you? Why not? What's the issue? Well, I think the issue is that really someone who is controlling the board and indeed managing the company has full power across the board. In one sense, there's nothing that they can't do. There's nothing that they can't control. So it's important for us to separate these areas, separate management and indeed the board's activities. In terms of remuneration, Some key points here. An effective scheme is going to do several different things. As I said up top, we do need the right people. So you have to pay at an appropriate level. Okay. Outside of that, certainly the scheme should align the interests of the directors, which to some extent will be personal, with those of other stakeholders, particularly shareholders. The scheme should also, be seen in the long term, not short term. We'll see this reference across the board in the SBL syllabus to short-termism and the avoidance of short-termism. And what we mean by that is, for example, remuneration schemes shouldn't encourage individual directors to think over the next month or quarter, or to think in terms of when their next bonus is paid. We've got to align schemes with long-term shareholder wealth maximization. Coupled with that, risk appetites. Different people have different views and appetites on risk. Shareholders may be risk averse, directors may be risk neutral or risk seeking. We need to ensure that remuneration schemes align that area. Next area for us is structures. Now, there's several possibilities here, and note that this area has come up in the SBL exam several times since September 2018. What we're really talking about here is the basic models on which the structure of a board can be based. Yeah, pretty simple, really. Either unitary or tier, i.e. usually 2 tiers, sometimes 3. But for our purposes, for the SBL exam, I think we can take it that we're either going to have one board, i.e. a unitary board, or 2 tiers. Now, in terms of detail here, for a unitary board, this is fairly usual, certainly in the UK and the US. Okay. Outside of that, we'll find on a unitary board a balance between executive directors and NEDs, and normally, certainly in the UK, around about 50-50. Okay. Next key point is that as a group, they are responsible, in effect, sort of jointly and indeed severally. So, they live and die by their decisions. They are all responsible. And that, as we'll see when we touch on the advantages, is probably a good thing. Now, in terms of advantages, as just mentioned, they all have the same legal responsibility. That puts pressure on them to make good decisions that are in the best interests of the company, of the shareholders, and indeed of all stakeholders. If something goes wrong, each of them are in effect liable. Next key point, certainly having that balance of NEDs involved does provide that additional expertise. And note that NEDs can have skills perhaps that are complementary or indeed completely different to executive members. So listed companies, for example, in the UK or indeed under other regimes, perhaps SOCs, can search for highly qualified NEDs that have the skills that they lack. Next key point is certainly NEDs, or indeed one of their roles, as we'll see later on, is to bring scrutiny to the board. They're there to monitor things. They're there to question things in the right way, of course, but everyone knows that. And certainly the executive directors will be aware of NED's role. Now, in terms of this unitary side, it seems good. It seems sensible. What are the disadvantages? Well, the first problem is that really, we simply have on this unitary board executive directors, i.e. involved in the day-to-day management, and NEDs, this overseeing scrutiny role. We don't have anyone else. There's no specific provision, for example, for the specific needs of employees or customers or suppliers. Really, those needs are covered by the involvement of NEDs. So that's one key disadvantage. It's just executive directors and NEDs. Outside of that, In terms of this role, as we'll see when we explore NEDs in a little bit more detail later on in this mind map, this is quite a demanding role, and it may well be that some NEDs have other non-executive director positions. So, doing it properly, giving the amount of work required, giving the intensity, you're really monitoring or scrutinizing other high-end, experienced individuals, and where there are issues. I mean, that's tricky. It's tricky to do. A lot of time and expertise is required. In addition to that, really, when you think about it, given that NEDs are not employees, they come from outside the business, possibly even outside the industry. Their position may be undermined to some extent because people may see them as outsiders who are just coming in and watching us and reporting on us. They're not like us. It's an us and them situation. That could undermine their role. Next area for us is really the tiered board. Now, as I said up top, we're talking sort of two levels generally, or two sides, sometimes three, but for our purposes in the SBL exam, I think we can take it as basically two sides. So what are the two sides to a tiered board? Well, the first one is what we would refer to as the management board. And the second area is the supervisory board. Now, as you probably guessed, the management board really is responsible for running the business, for entrepreneurship, ideas, creative ideas, business acumen, etc. For compliance with regulation, for example, in relation to filing of accounts, tax, etc., etc. And indeed, fourthly, for reporting on their activities and their actions to the supervisory board. So you can see here that the executive running of the business is done specifically by this management board. So if that's the case, what does the supervisory board do? Well, here we're talking about, approval and evaluation of strategy, and the strategy decided upon by the business, by the executive directors. Certainly monitoring company performance and functional statements against, the mission, vision, and in particular, corporate objectives. For sure, safeguarding shareholders' interest, that stewardship role that executive directors are employed to do needs to be monitored. Are their assets being safeguarded? Let's keep an eye on that. Calling shareholder meetings, obviously, and then the whole area of sort of selection, recruitment, and indeed dismissal, as it were, of members of the management board. So again, I think in summary, in terms of this second part, we're referring to a tiered board structure. Really what we're saying is that the supervisory board does just that. It sort of supervises and oversees really key areas in relation to the business. Given that, what are the key advantages of operating a tiered board? Well, I guess first things first, it's a separation, a clearer separation, if you will, of the two key sides to the functions and operations of the board. On the one hand, you've got the business itself, running the business, dealing with everything that's involved in that, the compliance, etc. Okay, and on the other hand, you have really top-end areas, supervising, monitoring, ensuring that strategy is correct, ensuring that the business is heading in the right direction, etc., etc., etc. The next key area is really that within this tiered board, you'll find that it's not only NEDs who sit on it, it will also be representatives of other stakeholders. So, for example, groups that represent investors or possibly employees. So you really got a broad spectrum of people on that supervisory board, and that provides the advantage because you're getting their views, but as we'll see below, also may create a disadvantage as well. Third key point, my apologies, this supervisory board has power. For example, it has the power to appoint and or remove individuals from the management board. Absolutely. And if you think about it, in practice, if you've got a second board or secondary board who have the power to not only just monitor the activities of the management board, but also to remove people, that would focus my mind if I was an executive director on the management board. Absolutely. Next area for us really is the disadvantages, and there are several. I think that while the advantage of splitting those key areas, management versus sort of overseeing or scrutiny, that could create problems in terms of the demarcation lines. Where does the line end? Exactly where is the mark between the running of the business in a broad sense and indeed the supervising of the business? That could create difficulties. In addition to that, as mentioned up top, where we have these representatives or groups representing other stakeholders, for example, employees, that's just the one that I've taken, it could cause problems because perhaps there's an action or a possible strategy in play that is good for the business in the long term, good for the shareholders. Perhaps it's a sale of a division, perhaps an expansion elsewhere, perhaps a restructuring. That may well be for the benefit of the business, but employees may feel that it's not for their benefit. So they could delay or possibly block decisions that they see are not in their own interests, but certainly would be in the interest of the company. Outside of that, certainly when we think about nominations to the board, the more people involved from the more areas, the more sort of stakeholder groups that are in play or in situ in relation to the composition of this supervisor, the more difficulties there are. It could be that someone slips the net. In other words, that let's say an appointment or several appointments are not quite as independent as they're supposed to be. So that's an issue. Okay, moving on from there, when we think about non-executive directors, we've said so far that non-executive directors are crucial for an effective board and indeed crucial for the business. They provide sort of independent scrutiny and supervision really over what exactly is going on. So let's delve into this in a little bit more detail. Over and above what we've said, and there's some overlap here, some repetition, their role. What are the main roles of NEDs? Well, the first one, and we've already mentioned this, is strategy. So really, the directors or executive directors are sort of in line to decide on strategy, to formulate strategy for the business. But we have NEDs really adding sort of their weight to that. They're going to, note, constructively challenge. That's important. They can't just challenge everything that executive directors try to do or want to do or suggest that the business should do. They need to do it in a constructive way, in a positive way. Okay? Next key point in terms of roles is this scrutiny area. Now, we've seen this word several times. In essence, what we're talking about is based on their experience, based on their expertise, they need to, assess the performance of the business and indeed the performance of management against goals and objectives. The bottom line is that the reason that we decide on objectives, mission, vision, etc. at the outset is to head in a certain direction. That could be in the terms of profitability, it could be in terms of revenue growth, etc., etc. So the bottom line is that NEDs are required and indeed in effect employed in inverted commas to scrutinize actual versus stated objectives. Next key area for us is risk, and this is absolutely key. We'll see later on that certainly the risk committee is an important committee within the business. So in terms of risk, what are the NED's tasks to do? Well, they need to ensure the integrity, so the honesty of financial information. How are they going to do that? Well, systems, controls and systems. If we have solid, bulletproof risk management systems, then it's highly likely that our financial controls, our internal controls, are also going to be pretty robust and bulletproof. That has to mean that the financial information, whatever that is, let's say it's the financial statements, for example, that will have that degree of high level honesty, integrity. Okay. The last key point, and again we've touched on this already, people. NEDs are involved in, not least the remuneration area. We'll see later on, we'll talk a little bit about the remuneration committee, but also in appointment and removing executive directors. And indeed, as mentioned, if it's you or me, and we know that there's someone overseeing us, keeping an eye on us, not just our remuneration, but how we do, performing against objectives, etc., then that tends to focus one's mind. So outside of that, in terms of skills and effectiveness, what sort of personal skills would be necessary? What do we need? Well, clearly we need someone who shows integrity, honesty, and indeed has a strong moral compass. Someone who knows the difference between right and wrong, what's good and bad, and someone who promotes the idea within the business of fairness and morality, and indeed that all stakeholders get treated in the right way, that there's not some group of stakeholders who are shown preferential treatment. Next area is sound judgment, and obviously sound judgment is going to come from experience and indeed expertise, perhaps involvement in a multitude of different industries. Next area is important, I think, because everybody's different, but let's just say that you have a group of NEDs who are overseeing and performing their role within a given listed company. If you have a very, very strong set of executive directors, possibly very strong CEO, CFO, etc., it may be difficult to deal with them, but NEDs have to show willingness to challenge people. They can't be shrinking violets. They have to challenge and they have to probe, and they can't take no for an answer. Remember that they're tasked with sort of scrutinizing the company and indeed, broadly speaking, protecting other stakeholders' interests. So, they can't step back, they've got to step forward. In terms of point number 4, interpersonal skills, things like communication, the sort of ability to listen, to be motivated, to get involved, to be enthusiastic, okay? So that's the personal attributes or personal skill size. What about broad areas in terms of effectiveness? Yes, you have some skills, but how can you ensure effectiveness in terms of your role as a NED? Well, as we said up top, certainly you need to understand these areas, and probity broadly meaning sort of honesty in one sense. You need to be ethically strong. We sort of touched on those. Number 2 is quite important. I think that NEDs need to be aware that executive directors do need support. Being an executive director, for example, in a large listed successful company is a lot of work. So these executive directors, perhaps they may be younger than the NEDs. They need to they need to be supported by the NEDs. In terms of 3, again, we touched on this up top, questions intelligently, debates constructively. We need to have people that have the ability to ask the right questions at the right time to the right people. And indeed, as we said, a willingness to sort of step forward as opposed to step back. They can't just take yes for an answer or no for an answer. They have to question things. And indeed, 4th point, good listeners. I mean, broadly speaking, these are many of the sort of attributes, let's say, or areas that would be needed for a very, very solid manager of any business. Next key point for us is, given what we've said, we know what the skills are. We know how NEDs can be effective. we know we want them to bring independence and indeed a variety of other things to their role. But how can they be threatened? Well, they can be threatened in a number of different ways. The first thing is relationships with the business. And, there's a lot of information here. Students find it difficult to remember all this. Let's try and remember Ned's employee 5 years. This is a no-no. You cannot have been, or ideally, you shouldn't have been, an employee of the business within the last 5 years. That's a threat. You'll be familiar with the people, familiar with the business. It's not a good idea, okay? Next key point is sort of linked into that. Note it says a material business relationship. We're talking about something that is significant. Ideally, again, you have not had any form of business relationship, for example, as a supplier to the business, or even as a customer to the business in the last 3 years. So let's remember employment, 5 years, relationship, 3 years. Next key point for us is really the idea that we referred to earlier on about the difficulty with this role in terms of time and input. If an individual NED holds multiple non-executive roles in different listed companies, that's tricky. Tricky in several senses, not least in terms of, let's say, confidentiality concerns, but also in terms of time and effort. Too many non-executive directorships have been seen to create problems in several different ways. Last key point is, again, linked into what I've just said, time. If a NED, however well qualified, however, what level of skills this individual has or reputation, if they haven't got enough time to do this job, to provide this role to this particular listed entity, let's say, that is a problem. Okay, now, broadly speaking now, we know that we have to have NEDs. NEDs are a requirement within, for example, the UK code. So it's not a question of, we don't want them. But what are the advantages? Now, again, we've touched on many of these points, so let's re-emphasize. Clearly, they bring independence. This is an independent group of individuals who are bringing just a range of things to the business that broadly we don't have. They are bringing a check function in one sense. Next area for us is obviously the expertise and the knowledge. We can choose NEDs carefully. We may have gaps in certain areas. For example, IT, AI, law, etc., etc. So they can bring what we do not have. Okay. Next key point. 1 second. My apologies. Diversity. Now, we've mentioned this, and as I said, there are several sides to this. These are the basics. It may well be that we bring in NEDs of a certain age. Perhaps they've been in business, perhaps they're retired. So, age, in one sense, brings wisdom. We can also bring a different mix of gender to the business, and I think that's important to have that balance between male and indeed female, and indeed ethnicity, bringing people in from different races, that's also important. So remember, that's just the basics. Okay, so sounds great. What about the disadvantages of NEDs? Could there be disadvantages given all the positive things that a good group of NEDs would bring to a listed business? Well, yeah, there are. I think first things first, and I mentioned this, good quality NEDs, suitably quality NEDs, they may well be thin on the ground, depending upon the industry that our business is involved in. It may be very, very difficult to find enough good quality NEDs. Outside of that, in any business, it doesn't matter if we're talking about NEDs versus executive directors or management versus lower level management, there's going to be conflict. So given that you're bringing in individuals that broadly speaking are there to sort of supervise, to oversee, to scrutinize what's going on in the business, that is going to lead to conflict. And note that in terms of conflict, there's nothing wrong with conflict as such. Conflict in most senses where you mention it, people think conflict is destructive. It's negative, it's bad. But it can also be constructive. So while this is seen as a disadvantage, to some extent you can think that, well, this creates open dialogue, keeps people on their toes. But at the end of the day, we try to guard against or avoid, constant destructive conflict with executives. But that is going to happen. Last key point, it could be that this whole NEDS area for some businesses, and we see reference to this in the press, not very frequently, but from time to time, perhaps a little bit of window dressing by companies. And then there's the idea of bringing in NEDs, complying with corporate governance requirements, is not done with the motivation of, using them effectively. It's more for window dressing. It's more for the impression that NEDs give to other stakeholders, whereas in fact perhaps we have a very, very strong executive set of directors and we don't really listen to what the NEDs say. They're all a bit weak, etc., etc. So, this is a problem. How do you deal with that? Well, you get strong NEDs in. You get people that aren't afraid to put their foot down. They're not afraid to, as mentioned up top, to challenge executive directors. Next key point for us is really an area that sort of concerns not just executive directors, but also non-executive directors. Okay, so let's say we're running a business, we have a good quality board, including executive directors managing, running the business. We have a good set of NEDs. We've got to keep them up to date. We've got to ensure that we, for example, as we see, have induction procedures upon arrival, that we have CPD procedures in terms of their continuing development, and also that we appraise them on a regular basis. We don't just sit back post-appointment and then just leave them to do their job. So what areas are relevant here? Well, in terms of the induction, this is something that was really put forward or encouraged on the back of these two reports in the UK. Now, we don't need to remember the names. What we do need to remember then is what these reports suggested in relation to induction. And remember, with many of these areas, a lot of what's included, as we're just about to see, is really good common sense. And we could apply this area really to any induction process. So what the Higgs and indeed the Tyson report suggested in relation to a high-end satisfactory induction process is that certainly in the first instance, it should communicate the business's vision and culture. Now, we know from our studies that what we mean by that is a vision is broadly what this business is about. It's a sort of, in one sense, the sort of ideal future. This is where we aim for, everything being perfect in the world, okay? The culture of the business, just referring to Handy's definition, Handy suggested that culture anywhere within a business, within a country, is the way we do things around here. So first things first, a good quality induction process, let's say for executive directors or for non-executives, should make it clear as to what the business is about, where we're aiming for, how we do things. Linked into that, certainly, I guess on the flip side, practical procedures, basic things, security, training, etc., etc., need to be communicated to the individual. Number three, certainly induction procedures need to be such that once the process is finished, the individual director or indeed NED can become productive right away, can get to work. We can't have some other hoop or some other hurdle for the individual to have to jump through to be able to do their job, okay? Fourth key point, feeling welcome. This is important, and indeed feeling useful. The induction procedure or process needs to be such that, the individual, once they go through it, feel, I'm able to do my job. I'm welcomed here. I have everything that I need to do my job. And then fifth key point, obviously, the retention of individuals. It needs to be good quality. This is the first experience, I guess, that a new executive director or indeed a new NED will have. So, it's crucial that you get it right. We don't want people walking out halfway through the induction process or even soon. Okay. So that's the guidance from the two reports